So imagine standing outside an incredibly exclusive nightclub, and you've got like $1,000 in your pocket.
Okay, $1,000, not bad.
Right. And the drink you want inside, it only costs $20.
Easy enough.
In a normal, functioning world, you just walk through the front door, you hand over your cash, and you buy it. But what happens when you step up to the bouncer and he just looks at your cash, laughs, and says, "Money doesn't matter today. You do not have permission to enter."
Yeah, that's a very different situation.
Exactly. And welcome to our deep dive for the Friday capstone edition of Gilded News. If you are tuning in expecting just a standard bullet point recap of what happened Monday through Thursday, you are definitely in the wrong place.
Right, we don't just read the news here.
No, absolutely not. We're here to synthesize exactly how this week's news cycle was built, identify the underlying narrative pattern, and then really rotate your attention toward the fresh catalysts that are going to drive next week.
And honestly, that bouncer analogy you just made, it's the perfect lens for what we are seeing across the global economy right now. Because if you just look at the surface, I mean, the consensus news cycle really tried to sell you 4 completely separate, disconnected stories this week.
Right. We have the jobs shock.
Yep. We had a baseline consumer price index, the CPI print. We had a localized panic over the power grid, and we had a brand new geopolitical rule about AI chip exports.
So 4 totally different sectors, 4 different headlines.
Exactly.
And the standard interpretation, like the one you'll hear if you turn on mainstream financial television, is that you're just supposed to react to those 4 things individually, right? Just in a vacuum.
Which is completely wrong.
Right. Because when you stack our sources together, the actual SEC filings, the Federal Reserve calendars, the primary data from grid operators, a totally different, highly coordinated picture emerges.
It really does.
The global economy is no longer just running on prices. It is being run through what you called middleware.
Right, middleware. So in software, middleware is that invisible administrative layer that sits right between the operating system and the applications, right? Mm-hmm. It just quietly dictates what is allowed to talk to what.
Okay, I see.
And in the economy, this middleware is the administrative layer sitting directly between supply and demand. Institutions are literally moving the real levers of the economy upstream.
So it's not about the money anymore.
No, exactly. The defining questions for capital right now are not, what is the price of this asset? The new questions are, what is the queue to get it? And are you even administratively allowed to buy it?
So let's run this week's news through that exact lens. Let's look at the permission economy. Because on the surface, the consensus framing of the week was just so aggressively normal.
Almost boring.
Yeah, totally boring. Like, jobs were a little weak, CPI looked fine, and the AI chip export story was just largely written off as, your standard Washington versus Beijing geopolitical maneuvering.
It's just another Tuesday.
Exactly. And the market took one look at all of that and collectively decided to just move on.
But see, that consensus frame totally falls apart the second you look at the actual structural evidence, specifically the calendars.
Right.
Look at the upcoming March Federal Open Market Committee meeting dates and stack that alongside the Federal Reserve's Beige Book schedule.
Okay, wait. I need to pause you there.
Sure.
Because for those of us who, don't read central bank literature for fun on a Saturday, what actually is the Beige Book, and why does it matter more than just the raw jobs data?
Good question. It is essentially the Fed's ultimate vibe check.
Vibe check?
Yeah, literally. The Beige Book is this report they publish 8 times a year where the regional Fed banks go out and collect qualitative, real-world anecdotes from businesses on the ground.
Okay.
So it's not hard math. It's a restaurant owner in Dallas saying people are buying cheaper appetizers, or like a manufacturer in Ohio complaining they can't find welders. So when the hard data like that weak jobs print we saw aligns with the qualitative complaints in the Beige Book, it dictates what the Fed is administratively permitted to justify at their next meeting.
Oh, I see. So it isn't just a simple equation of fewer jobs equals lower growth.
No, not at all.
It is fewer jobs backed by localized complaints gives the Fed the administrative clearance, the permission to change their stance on interest rates without losing credibility.
You absolutely nailed it. It's about establishing the cover to act. And we saw this exact same permission structure gating the private credit markets this week, too.
Yeah, with the funds.
Exactly. We saw several massive funds suspending redemptions. So to go back to your nightclub analogy earlier, the bouncer isn't just standing at the front door. Sometimes you get inside, you have a few drinks, you decide you want to go home, and the bouncer's standing in front of the exit.
Oh, wow.
And he says, sure, your portfolio says you have the money. but your permission to exit the building has been temporarily suspended.
Which is the literal definition of jading. You lock your money up in a private credit vehicle thinking you're getting this, premium yield.
Yep.
But the catch is, it's the Hotel California. You can check out anytime you like, but you can never leave. Or at least not until the fund manager gives you permission.
Exactly. And then, we saw it play out at the geopolitical level with the new AI export frameworks, too.
Right. The borders.
That is literally a bouncer at the national border permissioning who actually gets access to raw compute power. And finally, we saw it with the physical power grid.
The queues.
Yeah, the interconnection queues, the literal waiting lists just to plug a new facility into the transmission lines. They're essentially a velvet rope determining which data centers actually get permission to draw electricity over the next 5 years.
It's wild. And, if you've been following the discussions on our X account at Real Gilded News this week, you've definitely seen this permission structure popping up everywhere. I mean, people are definitely catching on to the pattern.
They are. And the paradigm shift you really need to internalize here is that price signals still exist.
Right.
We aren't saying the concept of price is dead.
Right.
But the binding constraint on the global economy is increasingly administrative. Rules, queues, and these contractual gates are now deciding whether the price even matters in the first place.
So how do you actually use this information, right? Next week, I want you to ask yourself one single question every time you read a financial headline. Is this story actually about price, or is it about permission?
That's the perfect filter.
Don't just look at the stock ticker. Track exactly which layer is tightening. Like, is it the banking regulator, the regional grid operator, the private fund manager, or the National Export Control Board?
Because the investors who only watch the price, they're going to be completely blindsided when their permission to trade just gets revoked overnight.
Exactly. Which brings up a fascinating mystery, honestly. If all of these gates are slamming shut, right, and capital is being trapped or delayed across all these multiple sectors, why isn't Wall Street in full-blown panic mode right now?
Yeah, it's a great question. You would think that gating funds and blocking data centers would trigger massive, massive sell-offs.
Right. But the buzzwords we were fed this week were incredibly sedating, I guess.
Very sedating.
CPI was deemed in line, the power grid stress, the utilities will just figure it out, Japan's monetary policy. The central bank is just being prudent. Everything was framed as totally drama-free.
Well, Wall Street isn't panicking because they're being actively sedated by the language of baselines.
What do you mean by that?
The market is being trained to view these severe constraints as completely normal. We call this the engineering of baselines.
Engineered baselines.
Yes.
Yeah.
Words like inline, prudent, and manageable. Those are not objective mathematical measurements. They are narrative frameworks specifically designed to tell you what you are allowed to ignore.
Okay, give me an example.
Let's look at that CPI print. Calling inflation in line trained the public to look at the top-level headline number and completely ignore the toxic distribution underneath it.
Oh, I read through that distribution. And calling it in line is like saying, a restaurant has great food on average simply because the appetizer was a Michelin star masterpiece.
Right.
Even though the main course literally gave everyone in the dining room severe food poisoning. The average mathematical experience looks fine, but the reality is structurally disastrous.
That is painfully accurate because the headline number masks a massive divergence. Shelter costs, rent, housing, the things that are sticky and represent massive structural parts of a family's budget, they are still running incredibly high.
Extremely hot.
But they're being offset on paper by energy costs, which are notoriously volatile and can reverse direction based on, a single headline out of the Middle East.
Yeah.
So the baseline was engineered to make you ignore the sticky inflation and just celebrate the volatile deflation.
Yeah. Wow. Okay, let's apply that to the power grid story then. We saw PJM making headlines this week. And for context, PJM is the massive regional transmission organization that coordinates the movement of wholesale electricity across 13 states and Washington, D.C.
Right, they power something like 65 million people.
Huge. And they are heavily leaning into this bring your own generation model for data centers. The PR narrative being sold to us is that this is an innovative public-private solution.
Sure, that's the PR.
Yeah.
And what happens when we look past the PR?
Well, let me push back on you here for a second, because On paper, if a tech giant like, say, Microsoft or Amazon wants to build their own mini nuclear reactor or a massive solar farm to power their new AI data center, isn't that a good thing?
You think so?
Right, like they are taking the burden off the public system, so why is that a negative constraint?
It sounds great until you realize they are privatizing the reliability while socializing the failure.
Oh.
Building a microgrid doesn't mean you actually disconnect from the main grid. It just means you use your private power when it's cheap and efficient, but you still rely on the public grid as your ultimate backup.
So they're still plugged in?
Absolutely. What PJM is doing by normalizing this bring-your-own generation model is training the public to accept a massive structural constraint.
Which is?
It basically says the public grid is tapped out. If you want reliable power to run the economy of the future, you have to build your own private infrastructure.
Right.
But the taxpayers and everyday ratepayers are still going to foot the bill for maintaining the broader failing grid.
Wow. It's a two-tier system for electricity.
Exactly.
And speaking of two-tier systems, I noticed the Bank of Japan doing the exact same narrative dance. The financial press keeps calling them prudent for holding off on raising interest rates.
Oh, calling the Bank of Japan prudent is the ultimate engineered baseline. They aren't prudent, they are paralyzed.
Paralyzed.
Yes. Let me explain the mechanism here because it is crucial. For decades, the Bank of Japan has run a policy of yield curve control, which basically means they have printed money to buy massive, unprecedented amounts of their own government's debt just to keep interest rates at zero.
Right.
They own more than half of all Japanese government bonds.
So if inflation spikes and they try to act like a normal central bank and raise interest rates to fight it, what breaks?
Their own balance sheet breaks. If they raise rates, the yield on all that debt goes up, the value of their existing bonds plummets, and the cost for the Japanese government to service its debt absolutely explodes. They could literally bankrupt their own treasury.
That's terrifying.
So they are entirely frozen. But instead of admitting they are trapped by their own debt, the narrative engineers brand that paralysis as prudent patience. It trains the market to accept a trapped central bank as a stable central bank.
And we saw the exact same psychological training with the mega bond issuance this week, right alongside that private credit gating we unpacked earlier.
Yes, the big corporate deals.
Massive multi-billion-dollar debt deals are clearing effortlessly for the absolute biggest corporate players in the world. Meanwhile, smaller, middle-market investors are just locked inside private credit vehicles, unable to withdraw their cash.
It trains you to just shrug and accept a two-tier capital market as the natural order of things.
Right. So the real narrative of the week wasn't things are fine. The narrative was constraints are normal. The bouncer isn't just turning you away. He's convincing you that standing on the sidewalk was your idea all along.
Exactly.
So here is your mental filter for next week. Whenever you hear a talking head on a business network use words like in line, manageable, or prudent, I want you to stop and ask two questions. Which specific constraint is being normalized right now, and who is ultimately paying the price for it?
We spent a lot of time this week on inflation prints, grid stress, and AI export control. Here's why we're moving on, and here's what replaces it on your radar.
Okay, so we are moving from how these baselines are engineered to who actually engineers them on a global scale. Because the macroeconomic calendar for next week is an absolute pileup.
It is a staggering collision.
Between March 17th and 19th, we have 3 major central banks publishing their ultimate policy decisions within the exact same 48-hour window.
Right.
We're talking about the Federal Reserve, the European Central Bank, and the Bank of Japan.
Yeah, if you line up the official calendars, so the FOMC schedule, the ECB Governing Council dates, and the BOJ release schedule, they're practically stepping on each other's toes.
Now, let me play devil's advocate for a second. These are 3 wildly different economies, right?
Very different.
The U.S. economy is still running incredibly hot, fueled by deficit spending. Europe is sluggish, dealing with an industrial recession in Germany. And Japan, as we just discussed, is dealing with decades of structural weirdness and a collapsing currency.
Yeah, a total mess.
So given those realities, surely they have to diverge in their actual monetary policies, right? Why does the tight timeline matter so much if they're all forced to do different things anyway?
Because the tight timeline is the entire point. It provides narrative control.
How so?
When central banks are stacked this closely together on the calendar, narratives cannot hide behind time gaps. Let's say the Fed speaks on a Tuesday, and the ECB doesn't hold their press conference for 3 weeks. That creates a massive 3-week window where currency markets can obsess over how their policies are diverging. The euro might plummet against the dollar, bond yields start to swing violently, and the market has time to just panic about the gap.
So they lose control of the storyline because the data operates in a vacuum.
Exactly. But when they are stacked inside a 48-hour window, they can completely choreograph the global event. The true dynamic you need to watch for next week is not synchronized policy. They mathematically cannot synchronize their actual policies because their domestic economies are ripping apart in different directions.
Right, that makes sense.
What you're going to see instead is synchronized messaging.
I love that distinction. Synchronized messaging. The underlying divergence, the structural cracks between the US, Europe, and Japan, it doesn't magically go away.
No, it doesn't.
It just gets heavily, heavily managed through the theatrical ritual of the press conferences. They use the tight schedule to project the illusion of a coordinated global adult in the room.
Yes. So how do you actually track this in real time? You need to build a scorecard.
Okay, a scorecard.
Before these decisions drop on the 17th, I want you to take a piece of paper and draw 3 columns. Column 1, the inflation story. Column 2, the growth story. Column 3, the financial stability story.
And as Jerome Powell for the Fed, Christine Lagarde for the ECB, and Kazuo Ueda for the BOJ step up to their respective podiums, I want you to track which of those 3 columns they choose to emphasize.
Exactly.
If the Fed leans hard on the resilient growth story, but the ECB completely ignores growth and suddenly pivots their messaging to protecting financial stability, you have just found the exact seam where the synchronized messaging is trying to cover up a structural crack.
It cuts right through the noise in the press release. But we need to take all of this abstract monetary policy and slam it right into the physical, real-world constraints of the permission economy.
The physical world.
Yes, because that brings us to the defining event of the week, NVIDIA's GTC conference as a macro capex signal.
Next week, starting on Monday, March 16th, AI is going to stop being this abstract software trend about chatbots writing poetry and is going to officially turn into a massive physical capital allocation plan live on stage at the SAP Center in San Jose.
NVIDIA's GTC keynote is exactly where the permission economy meets the physical world.
Now, in any other year, I would look at this and say, okay, it's a tech keynote, right? CEO Jensen Huang is going to walk out in his signature leather jacket. He'll hold up a shiny near silicon wafer to the cameras, talk about a new foundational model with 1 trillion parameters, and the developers in the crowd will all cheer.
And if you view it purely as a tech keynote, you will entirely miss the macro event of the quarter.
How should we reframe it then?
We need to reframe NVIDIA GTC entirely.
Right.
Based on the sheer scale of capital expenditure involved, this is no longer a product launch. Think of Standard Oil laying down pipelines at the turn of the 20th century.
Wow.
GTC is essentially a forward-looking earnings call for the entire global infrastructure ecosystem.
An earnings call for the global ecosystem. Because it ties right back into the bouncers and the velvet ropes we talked about at the very beginning.
Yes, exactly.
The defining question at GTC next week is not, what is the parameter count of the new large language model?
No, the real question is, what is the physical build schedule for these data centers, and who on earth is going to pay the power bill to run them?
Because you can design the most advanced, hyper-efficient AI chip in the world, but if the bouncer at the regional power grid won't let you plug it into the wall for another 4 years, your chip is just a very expensive, very shiny paperweight.
Exactly. AI is hitting the hard limits of the physical world. Copper, cooling systems, concrete, and raw electricity. That is what GTC is really about. It is a roadmap for how trillions of dollars in capital are going to navigate those physical permissions.
So if you are streaming that keynote on Monday, just forget the flashy software demos. I want you to listen for 3 specific tell phrases. First, listen for the words efficiency or inference.
This is a massive tell. Training an AI model takes a huge, concentrated burst of power for a few months. But inference, which is when the AI actually runs and answers the user's prompt in real time, that takes power every single time someone hits enter, billions of times a day.
Right.
When NVIDIA talks about efficiency and inference, they're signaling demand management. They're quietly acknowledging that the global power grid is constrained, so they have to invent ways to make the chips do more math with less electricity.
The second phrase you need to listen for is sovereign AI or national AI.
Yes. When you hear sovereign AI, you are hearing the language of modern industrial policy. You are hearing the permissioning of compute power at a nation-state level.
Ah, the borders again.
That is the export controls we discussed earlier, no longer just acting as a political tool, but manifesting as a core business strategy.
The VIP club gets its own border patrol.
Exactly.
And the third phrase to listen for: anything related to power, cooling, or infrastructure.
Because when the CEO of a chip company spends time on stage talking about liquid cooling pipes and electrical substations, it signals that physical constraints have become so severe that managing them is now a core product feature.
It's not just an operational afterthought for the customer anymore.
No, not at all.
It is all completely connected. The Fed's permission to cut rates, the grid operator's permission to build data centers, and NVIDIA's hardware roadmap to navigate those exact gates.
That's the week. Not four disconnected stories, one shift toward a permission economy where the binding constraints are rules, queues, and gates.
And next week, we get the cleanest test of that shift: 3 central banks inside 48 hours, and AI's CapEx plan on stage at GTC.
On Monday, we'll start the week with the first tell from GTC and what it implies for power, pricing, and policy.
Follow Gilded News on X at Real Gilded News for daily clips and the stories behind the stories. As you watch these velvet ropes go up across the economy this weekend, I want you to ask yourself one final question. When the cost of getting permission gets too high, whether it's grid queues or chip exports, where do the black markets for compute power and electricity start popping up? Because historically, whenever the front door is blocked by the bouncer, someone builds a very profitable back alley. Think about that this weekend. We will see you on Monday.